In simplified terms, sukuk are the Islamic equivalent of conventional bonds, with some structural nuances to comply with Islamic principles. So, for performing obligations with similar structural seniority issued by the same issuer, sukuk and conventional bonds have the same economic risk and return drivers. For these reasons, you will see that sukuk find a natural home not only across faith-based mandates but also across conventional and more socially responsible mandates. So, the COVID-19 pandemic undoubtedly left visible scars on the global economy. But despite a fairly difficult year in terms of public health, sukuk markets had a stellar year. The Dow Jones Sukuk Index, which represents the investment grade segment of the market, was up about 8%. The broader emerging market ENBD market iBoxx index, which represents both the high grade as well as certain riskier segments of the market, was up about 7%. So you can see in absolute terms, the sukuk markets performed quite well. But for those of us who've observed the sukuk market for a decade, we know that sukuk markets have a lot of resilience as compared to the emerging market counterparts. And this unique characteristic of sukuk was at full display in 2020. Not only did the asset class experience a much lower drawdown in relation to its peers, but they were among the first instruments to recover in April and May. So over the last decade, the sukuk markets have generated annualized returns of north of 5% gross of fees. And 2021 is also setting up to be a pretty strong year for sukuk. So while the markets have largely recovered the spread widening as well as the price losses which were suffered back in 2020, in 2021, the segments of the market which lagged, such as industrials, real estate and aerospace, as well as sovereigns with weaker balance sheets who came into the crisis, those are the sort of sectors we think would offer some very attractive, strong excess return opportunities in 2021. So we think those returns are going to be more backloaded, as the first half of 2021, markets are going to remain a little challenged by rising interest rates. But we see a few positive drivers for those returns in the second half of 2021. Reducing caseloads should definitely help. And as vaccine rollouts pick up pace, it should allow a lot more businesses to return to some sort of normalcy. Secondly, 2/3 of the sukuk instruments are issued by Islamic countries whose economic prospects are closely tied to the price of oil. As oil finds a trading range in the $60 per barrel, it should definitely allow a lot of these countries to address their fiscal and external imbalances to some extent. Thirdly, 2020 was a year with a big regime shift at the Fed. The new reaction function at the US Fed entails a lot higher tolerance for inflation, which means we are unlikely to see a premature tightening in monetary conditions. This should not only be positive for the broader fixed income markets, but also for the sukuk market. And lastly, sukuk assets, or the Islamic assets in general, total about $2 trillion. But we saw very tepid issuances in 2020. The combination of a lot of the assets trying to chase sukuk and very limited issuances also provides a very strong technical backdrop for sukuk markets to perform well in 2021. We see three primary risks to this outlook. The first one relates to lingering concerns around virus mutation, vaccine efficacy, and to the extent this starts to impact either a vaccine rollout or results in any gradual delay in reopening of the economy, it would certainly put a dent on this recovery trade. Secondly, there is very limited valuation cushion right now left in the market following the very strong 2019 and 2020. Any premature repricing in Fed rate hike expectations or a volatile sell-off in interest rates would certainly have some impact on the markets. And lastly, it relates to inflation. Although this is not one of our bigger concerns, as we still see a lot of slack in the economy, very high level of permanent unemployment, which should keep any increases in wages in check, and as a result on inflation as well. One of the major underpinnings of the sukuk market is its relative defensiveness to interest rate volatility. And the reason for that is inherently sukuk as an asset class doesn't respond as aggressively to rising rates as you only have a handful of instruments in the long end of the curve. During the last monetary policy tightening cycle in 2015, 16 and 17, sukuk markets eked out positive gains. For example, in 2016 and 17, the Dow Jones Sukuk Index posted gains north of 4%. In 2018, despite exogenous risks such as the US-China trade war, the asset class eked out positive returns. Our view in relation to interest rates and sukuk is it's nothing to fear. Segments of the sukuk market do carry attractive cushion to absorb any rate hikes. And at the same time, you do have a lot of spread compression opportunities in relation to segments which lagged in 2020, such as real estate, industrials, and aerospace. So we have a positive cross-asset view for GCC markets for 2021. The economies in this part of the world have suffered quite a lot in the past couple of years due to lower oil prices, and at the same time, COVID-19 had a disproportionately huge impact on parts of the economy which are dependent on trade and tourism. But what these two events have done is it has forced some long-term structural adjustment to the economy, which should serve these economies fairly well in 2021 and beyond. In relation to fixed income, we have a fairly positive view on Bahrain and Oman, which not only have a high beta to oil prices, but also have undertaken some very strong structural adjustment to improve their sources of revenues in relation to non-hydrocarbon part of the economy.